don't worry, the summer is going through an extended period. It's going to be potentially the hottest September on record tomorrow in London. Should be knocking 30 degrees. So all is not lost. However, in terms of financial markets, not on a good start to the week thus far. Risk off, in fact, seen since the Asian session. That's kind of fed through into the European Open this morning, and it follows the lower close that we had on Wall Street on Friday. Now, I was actually away doing some lecturing on Friday afternoon, but I'm just looking at on my charts here that you can see that I'm sharing, looking at the S&P on Friday. And wow, look at that, it's one-way traffic as the market, of course, starts to reprice the prospect of the Federal Reserve next week hiking interest rates. And some of the commentary that we had specifically came out of Rosengren, who added that a failure to continue on the path of gradual removal of accommodation could shorten rather than lengthen the duration of the recovery that we are in at the moment, i.e. someone who normally would slightly leaning on the dovish side, sounding more hawkish, in line with fellow colleagues, obviously not quite as direct as some of the outright hawks on the Federal Reserve, but certainly if the doves start to err on the side of prepping up of a September hike, then this is what occurs. Equity markets start to reprice the possibility that a hike could be forthcoming, and that's predominantly what we're going to focus on in this briefing this morning, because looking at, you can see here, Asia was down overnight, so the DAX future, this middle left chart, you can see is gapped lower, playing catch up with the losses that we're seeing in the Asian indices overnight and that lower close in Wall Street on Friday. So we are down already fairly significantly in the futures. The dollar is a little bit softer, but bear in mind it did rally a fair bit on Friday's afternoon, and so a bit of a recovery in both major pairs, but the dollar is going to be really the key asset to look out for movements there this week as we determine whether or not September will be viable for the Fed to lift rates. Likewise, though, from a central banking point of view, you can see the Bund also on the back foot as well as the DAX. So rather than being your classic kind of risk-off move where you generally have lower equities and a bid in fixed income futures, actually, Bunds are continuing to move lower. Now, if you remember last week, the direction of Bunds on the back of the ECB on Thursday, look at Bunds since the ECB spoke. You can see here quite clearly, pretty one-directional. We've just been continuing to power lower. You know, if I just change the transition, my charts here, interesting graphic that I saw this morning that I think kind of really summarizes the state of play presently. You can see here the white line is the volatility index. So the MSCI is the all-country world index, so it's a good gauge of sentiment across all of the world's major equity indices. The white line measuring the volatility, as you would imagine, post-Brexit is when it spiked the highest, massive amount of uncertainty on the market on how the post-Brexit world would look like. However, given that as being not as bad as feared, that quickly came back. Likewise, that's when you had the converse relationship, the dip in global indices on Brexit. However, has recovered quite substantially. The only problem is, more recently, i.e. at the end of last week, you've had the MSCI dip lower and the volatility index spike up. Of course, nowhere near the type of levels that we had immediately after the EU referendum. However, this is a slightly troubling trend that started to occur given the aggressiveness of the moves here. Now, why has this happened? Well, there's actually a couple of things at play at the moment. If you remember rightly, equity markets have been predominantly buoyed by the fact that they've been supported by central bank easing. The only problem is, last week we heard from the ECB not a lot, other than really kicking the can down the road. Not so much a matter of if, but when, will they look to extend the duration of their QE program, look to do some technical changes to the program? That is probably assured is going to happen, and most likely this year, but they did not make any firm signals in last week's press conference. In fact, they said at this point in time there is no need for any talk on more stimulus. There's no discussions on the duration of the program. That is why, since that time, just going back, these bunds have been severely under pressure because the market was expecting more QE over the longer term horizon. That did not materialize. Second to this, in terms of an Asian perspective, if you remember last week, you had the South Korean or the North Korean markets, and the South, I should say, in terms of the Kospi was under pressure, but the Korean won got hit. The Japanese yen also saw some movement on the back of that nuclear test from North Korea. Well, over the weekend, they've continued that rhetoric. North Korea is saying it's ready to conduct additional nuclear tests at any time, according to the ministry. So this was after the fifth test that we had was condemned by most major powers last week. But that continues to add a bit of nervousness to the market. Then as well, you had over the weekend, it was of course 9/11. So in the US, various ceremonies taking place, of which, more worrying from a political standpoint, Hillary Clinton actually had to leave the ceremony because she was feeling unwell. She was reported as overheating. She's on antibiotics at the moment. She had pneumonia 2 days ago. A lot of the Trump play a few weeks ago was questioning about the health of Hillary Clinton and can she be a real candidate to lead the country when, in fact, there's a lot of people saying that she's not in good enough health to be able to take on that type of role, and particularly going forward over the longer term. The only problem is at the moment is that what Trump says and what is truth is usually a far stretch of the imagination, but on this point, actually, Hillary Clinton's health is becoming a bit of a concern. Particularly when the elections are looming at the beginning of November, time is severely running out. And with the polls actually being very narrow at this point, if Clinton's health does start to become or deteriorate, this could be a very worrying sign for the market if it helps give further strength to the Trump campaign. So there's a couple of ongoing themes at the moment which are all culminating in this kind of nervousness in the market, which I think is what you're seeing at the moment. And none other than creating this uncertainty is the split among Fed members and what we're going to do with September. What we're looking at here is the probability of a SEP hike implied by federal funds futures. This is the short end of the fixed income curve, the most sensitive to markets changing expectations on interest rate hikes. And it's September that we're looking at. Remember, it's next week, the 21st, which is key. And you can see here, when we had that ISM service report, which came in much worse than expected, we all thought, well, that's September off the table then. The market certainly repriced from around 28% probability all the way down to probably 12%. The only problem is that Federal Reserve members have not followed suit. Despite the weak data, despite weak manufacturing service, and you could argue non-farm payrolls more recently, Fed members have continued to sound hawkish, in essence, prepping the market for potential September action. Brainard is speaking later today. We'll get onto that shortly, but when her speech was announced, expectations picked up again. Rosengren, of course, was the one that triggered that US equity market sell-off on Friday. Again, that's a dovish member speaking hawkish, and then that rose to 30%, which, as you can see here, is the highest we've had in the last week or so. But then Torillo came out, slightly tempered those expectations, but nonetheless, we are tracking more so. Latest we can see here, 24% at the moment. So certainly, if I remember rightly, from Friday morning, we were more like 15, 16. We're now up to 24. Now, one of the reasons why Brainard is so important today is she is the final piece of the puzzle for two real reasons. One, today is the last day the Fed can communicate before they go into their blackout period before the actual Fed meeting, which commences on the 20th with the announcement of the rates on the 21st. So today, if the Fed want to communicate a lasting message to the market of what they intend to do, it needs to come today. The reason why Brainard is important is because she is a voting member and, critically, she's a leaning dove. So if September is not going to happen, then you would imagine she needs to pull back some of these expectations. She needs to lower that 24 more down to possibly 15 or below in order to then minimize any market disruption when they do not lift interest rates in September. However, my feelings is that she's going to sound hawkish because she wants to prep the market a little bit more than this current 24. That needs to get up to more like 30 plus, more like 40% probability if, that is, the Fed are going to hike rates. So communication is going to be absolutely critical today. She's not actually speaking until 6:15 this evening, but by the finish on Wall Street, you should know by those closing percentage prices whether or not a hike is going to be a serious contemplation for the Fed. If equities, when you come in tomorrow morning in the US and they finish down more like 1.5%, 2%, possibly more, then you know that the Fed have been hawkish and that they're trying to signal to the market that they're definitely serious about that meeting coming up. In terms of what you guys think, I did do a poll on Facebook on our community page last night, asking you guys what you think the timing of the Fed hike will be. And quite interestingly, you're not believing, much like the market, what the Fed is telling us. The majority of you guys are going for, or 18 are going for December. And the reason why, if you remember, if you can see here, November has only got one person, and that's absolutely correct, I'd say. If they don't do September, most likely December, or if not, next year. The reason why September, December is so important, as I'm sure you guys are fully aware, is because that's when Janet Yellen has the updated dot plot projections and the accompanying press conference as well. So she can convey any changes with more greater detail with the press. So you can see here, very few of you actually think that the Fed will hike rates in September. I would say this is a little bit complacent. You know, the Fed have told us what they're going to do, essentially. I think to have that as such a low probability is a little bit ill-founded. I'd want to be, I'd say, slightly more 50-50 on whether they pull the trigger here. December, though, looks the most opportune after that, if not the majority or the next largest group of people then foresee actually they're not going to do anything. Of course, we have the elections in the US at the beginning of November. That's likely going to add to a bit of the Fed sitting on their hands waiting to see politically how things play out. Certainly if Trump does pull off the unexpected, then certainly Fed hikes are probably off the table. And then 2017 then seen as the next opportunity. You can see here, even my wife does not believe the Fed. Okay, so moving on. Actually, one thing to quickly look at, which is also going to be key for judging market direction this week, as I said, a predominant amount of which is going to be based upon expectations surrounding the Fed, is Thursday. If you think about it, the Fed get to communicate for the last time officially today before the blackout period. Today is actually very quiet in terms of scheduled economic data. Apart from Brainard later, that'll be the key event. Things start to pick up pace, but it's really Thursday here. If you look, you've got a huge batch of data coming out of the US. So from the US, you've really got nothing on Monday, Tuesday, or Wednesday really. They've condensed it all into Thursday. You've got retail sales, Philly Fed manufacturing, weekly jobless claims, PPI, industrial production, business inventories, Empire State Manufacturing, you name it, it's all coming on Thursday. And then from an economic data point of view, obviously in the US, key data has been fairly weak. So this data that's coming out on Thursday is going to be really key. Do we get a bit of a bounce back in the domestic numbers that will support then the wordplay from the Fed that will again start to increase expectations that next week or the week after next we will get a Fed hike. So potentially Thursday is going to be a very important day as well. I've already sent this out to you guys, so please do take a look and plan ahead accordingly. Other interesting things coming out, obviously post-Brexit, still looking at the effect of the devaluation of the pound and its effects on prices has been fairly minimal so far. But CPI due from the UK, RPI, PPI on Tuesday. Quite a lot coming out of China as well, not to be forgotten. Any blips in Chinese economic data is only going to act as a headwind for the Fed. And you've got Chinese industrial production, fixed asset investment, retail sales on Tuesday. You get some other data of note as well, new loans and money supply from China. So some other things there. UK interest rates get announced on Thursday, but much like this new apparent monetary theme, they too not looking at taking any action at this point. So you've gone through a cycle now. The central banks have given to the market some extra stimulus, and now it's kind of sitting on their hands and waiting to see how things play out. And the markets, in terms of equity markets for sure, might get a little bit nervous when you've been used to being propped up. When central banks start sitting on their hands, then we see the ultimate underlying strength of equities and can they hold up at what have been these elevated levels. Certainly from a S&P point of view, we're back down to 2100. That seems to be the line in the sand at the moment. Let me switch over. You can see already this morning finding a little bit of support around that just psychological level, beneath of which you've got S1 here. I did actually, let me just switch over to Twitter because I've just seen our head of trading, Piers Corrin, tweet. I'm always watching, Piers. You can't slip one past me. Here we go. So just switching over. So head of trading, Piers Corrin, has just tweeted here his view. S&P adding to Friday's big downside and significantly now below key level of 2120, which was the June double top. So just looking here, you can see here that's that level he was talking about. 2120 was key. You can see here in June at the beginning and in mid, before that big push lower that we had on Brexit, that 2120 was really key, this level. That has already broken and we're testing down at 2100 this morning. So if anything, not looking good technically either now in the S&P, allied to the fact that if the Fed and Brainard this evening communicate more hawkishness, potential for more further downside here. Okay, in terms of today's session though, just to kind of summarize, it's very quiet on the calendar today, so don't be expecting much in the way of a lead from economic data. Technically, we've just had a look at a couple of those equity charts, particularly in the S&P, so a couple things to contemplate. Have a think about just generally the week as a whole. You know, Fed communication, economic data from the US is of the utmost importance. They're going to be the things that are going to really drive the market from a macro and fundamental point of view. Certainly gold as well playing a little bit of catch up here. You can see this morning since we've come in, a bit of a sell-off through the cash equity open timing wise, and we're back down $4 as well there. Okay guys, going to leave it at that. Any questions, please feel free to shoot them in the chat. I'll take them on after the briefing. But enjoy your session, have a good week, and I'll see you in the chat room.